So this video will be all about candlestick patterns. In this long candlestick pattern video, we will start off quickly by taking a look at how do we read candlesticks and candlestick charts. And after that, we will go through multiple candlestick patterns one by one, at least the most common ones, and take a look at how do we identify them, what do they mean, and how can we use them in our trading. So this course is mainly meant for beginners, but even if you are a more advanced trader, you can hopefully pick some things up from this video as well. And guys, during the video, make sure to make use of the timestamps or video chapters. There I will name all the candlestick patterns one by one. And if you during the video feel like now I have gotten some value, then it's always super awesome when you show that by dropping a like. And last but not least, before we get started here, I just have to give a disclaimer. This video is for educational purposes only, and nothing in this video is financial advice. But alright guys, now let's get started right away here. So how do we read a candlestick chart? And let's start here by taking a look at what the color means. A green candlestick basically means that we have an increasing candlestick. The price of the stock or crypto or whatever is increasing during the period. And the opposite is true for the red candlestick. The red one is a decreasing candlestick. Another name for the green one is that we call it a bullish candlestick, and we usually call the red one a bearish candlestick. But let's be a bit more specific right here. The candlesticks basically consist of two parts. First of all, we have the sort of wide part of the candle. You can see on the green one from there to there, and on the red one from here to here. This is what we call the real body of the candle. So the wide part is called the real body, and you can see the small parts that are sticking up. You can see, for example, here on the green one, this is what we call a candlestick wick. So we can just call it a wick. And these different parts actually tell you different things about the price action in the candles. And for the green candlestick, what the real body will tell you, so what the wide part will tell you, is at which price it opens. So it opens down here for the green one, and it closes up here. So the price is at the bottom of the wide part in the beginning of the candlestick period, and at the end of the candlestick period, we are up here at the close. The wicks here, you can see the wick we have right here and down here, tell you the max and minimum point the price have been during the period. So for example, for this green one, the absolute max price that we got during this period was up here, and the lowest price we got during the period was down there. And the candlesticks can actually have different periods. For example, one candlestick can be 1 day, 1 hour, or 1 week. We will take a look at different time frames later on in this video. But what about the red one? Well, the opposite is true for the red one. So the price starts or opens up here, and at the end of the session, at the end of the candle, the price is down here. But during the period, we reached a max price, a high all the way up here, and we reached the lowest price, a low all the way down there. So this is basically the basics of, how to read candlesticks. Now let's actually jump into the chart here and take a look at how it looks like when we have many candlesticks on a chart. All right, guys, so now we're looking at a candlestick chart. And right now we're actually looking at Nasdaq, and we have a daily time frame. So every candlestick you can see on this chart represents 1 day. And if we would, for example, let's choose one candle. If we, for example, take a look at this green candle right here, we can see that the candle opened down here, right? So it opens at the low of the wide part of the candle. And when we closed up here. But during this period, in this case, we have days. So during the day, Nasdaq reached a low all the way down here, and the high was all the way down here. As you can see, the next day we have another green candle. And here you can see that we opened where the green part starts, so right here. And one thing to notice here is that we actually opened a bit higher than the previous candle. And this is possible because, you know, during the night, maybe we had some positive news, maybe something happened during, you know, the hours where trading was not open. So it's not uncommon that we see a gap in between two candles, and this is actually what we call this is one sort of gap. But in this case, the candle opened here, it closed higher up here, so we have a green candle. We always have a green candle when the close is above the open. But what you also can see on this candle is that we actually reached a low all the way down here. So during the day, the price went, you know, down and up. But all right, okay, so now let's touch upon time frames real quick. So we talked about that the candles can represent different times. Right now, every candlestick is 1 day, but let's say we want to zoom in a bit here and have a shorter time frame and change so that every candlestick is 1 hour. On TradingView, if you want to change this, you go up to the corner where it says D right here, and then you have different time frames. So you can see you can have as low as 1 minute and as high as 1 month. You can also choose even higher if you want to, but now let's choose 1 hour. So now instead of every candlestick represent 1 day, now every candlestick represents 1 hour. So let's take a look at one more example of how to read a candlestick. Let's actually take this red one right here. So in this case, the candle opened right here, but during the hour, remember now every candlestick is 1 hour, we reached a high all the way up here. However, the hour did end badly and we actually closed all the way down here. And during the hour, we reached the lowest price, even lower here. And now when we actually know how to read the candlestick charts, now we can start to apply some trading strategies and trading tools to our chart. So I'm not gonna go into detail at all in this video, but I just want to show, you know, some tools you can use. One tool, a very useful and very widely used tool, is the support and resistance tool. So as you can see here, we saw sellers coming in 1, 2 times. This right here is what we call a resistance. This was like 1 day later or so. We actually broke this one, so we got above the resistance, and this actually led to a very strong impulse here to the downside. And a common principle in trading is that we often flip previous resistance to become support. So as you can see, we did see resistance 1 and 2 times. We broke this one, but then when we came down to the previous resistance level, we actually saw buyers coming in at this support level. So this is one, you know, common principle in trading. And now I actually switched back to daily candles. So right now every candlestick is 1 day. And real quick before we wrap this video up, I just want to touch upon one more principle, and that is that we have something called candlestick patterns. And candlestick patterns are basically patterns that just by looking at the candlesticks and how they relate to each other, we have patterns that can give you signals, both signals that the price might reverse, but also signals that we might see a bounce, or even signals that, you know, signal that the market is uncertain. So for example, right here, we have a pattern called a bearish engulfing pattern, which is a potential reverse signal. And as you can see, after this one, we saw a strong impulse to the downside. Okay, so the engulfing pattern, what is it? Well, we have 2 different types of engulfing patterns. First of all, we have the bullish engulfing pattern, and we also have the bearish engulfing pattern. And let's start here by explaining the bullish engulfing pattern, what defines the bullish engulfing pattern, and what does it mean. So the bullish engulfing pattern consists of 2 candlesticks. First, we have a red candle, and then followed by a green candle. In some trading programs, the red candle is black and the green one is white, but the most common is red and green. And the criteria that has to be met in order for it to be a bullish engulfing pattern is that the first candle, as we said, is a red one, and the second candle is a green one. And this candle has to open below the previous red one and close above the previous red candle. And by the way, guys, if you need a video on how to read candlesticks, if you are a bit uncertain in that, I actually have a video, and I will make sure to link it up in the corner in the eye. But as you remember, the open of a green candle is here at the bottom, and the close of a green candle is here at the top. And in order for it to be a bullish engulfing pattern, we need to open below the red one and close above the red one. And this is, where the name comes from. The green candle sort of engulfs the previous red candle. As for the wicks, the wicks we have up here, down here, down here, they doesn't actually matter pretty much at all when it comes to the engulfing pattern. When we spot engulfing patterns, we only look at the real bodies. And the real bodies are, the fat parts of the candle. So this is the real body for the red, and this is the real body for the green. And another criteria, and this is actually an important criteria, in order for it to be a valid engulfing pattern, a valid bullish engulfing pattern, it needs to come after a downtrend or a strong move to the downside. So we have a downtrend, then we have this bullish engulfing pattern, and the hope is that this pattern will act as a potential reversal. So the hope is that after this bullish engulfing pattern, that we actually see the price reverse and continue up here again. So we can say that this is a reversal candlestick pattern. And the exact opposite is true for the bearish engulfing pattern. Here we have first a green candle followed by a red candle. And in this case, it is the red candle that engulfs the green one. So in this case, the red candle needs to open above the previous green one and close below the previous green one. And the same criteria needs to be met here. The bearish engulfing pattern needs to come after an uptrend. So we need to have an uptrend, a strong force to the upside, and then this bearish engulfing pattern hopefully acts as a reversal pattern, but this time to the downside. So the bearish engulfing needs to come after an uptrend. The bullish engulfing needs to come after a downtrend. So if we, for example, here have a price that goes sideways, and then we have a engulfing pattern, for example, a bearish engulfing pattern, in this case, the pattern is actually not that significant. So in pretty much all cases, you can ignore engulfing patterns that comes in a sideways or ranging price action. One last thing that is worth mentioning here is that the engulfing pattern is always better to use together with other technical variables. For example, you can use the engulfing pattern together with support and resistance. We will show an example of that very soon, but you can also use it with other technical variables. For example, RSI divergence, MACD divergence. You might use things such as Bollinger Bands and so on and so on. But the main thing here is that the pattern is on its own a signal, but together with other signals, it can become more significant. But all right, guys, so now I think we're ready to take a look at some real life examples of engulfing patterns and how to use them in trading. All right, so right now we're looking at the Netflix stock, a stock you have probably heard of. And can you spot the bullish engulfing pattern on this chart? We might have multiples here, but the one I'm thinking about and the one that meets the criteria is this pattern right here. You can see we have a green candle that engulfs the previous red one, right? I hope you can see here, the green candle opens below the prior red one and closes above. So this is an example of a bullish engulfing pattern. And what also made this a valid pattern is that it actually appeared after a downtrend, so after a strong decline. Then we saw this pattern right here. And in this case, it actually played out and we saw a very nice force to the upside, after this pattern right here. And what you also can see here on the chart is that we have a support line. You can see this white line right here. So this is an example, what I talked about earlier in the video, that we want to use the pattern together with other technical variables. So in this case, we have a line that have been acting, as resistance all the way back on June 23rd here, and then multiple times as support. So we both had support, that is one bullish variable, and we also had a candlestick pattern. So we at least had two bullish variables here. So that was very nice, and we could have gotten a pretty solid trend from that trade. Now let's also take a look at, the bearish engulfing pattern. So here we are on Apple stock, and this one might actually be a bit easier to spot here, but it can still be hard. The pattern I'm referring to is this one right here. And as you can see, in this case, we have a bearish engulfing pattern. The red candle opens above but closes below the prior green one, right? So the criteria is met there. And the other criteria that we have a strong, uptrend prior to the pattern also is met. You can see we have an uptrend and then this pattern appears. And after this engulfing pattern, we actually saw a pretty respectable force to the downside. So in this case, you could have made a nice short play. Shorting is basically when you bet against the market, or that you bet that the price will go down. In this case, however, we didn't have any other technical variables. We might have had a tiny bit of MACD divergence. So that is sort of almost that we have two variables. And by the way, if you want to learn more about that, I actually have some videos on divergences that I can link up in the corner in the eye. So here on the screen, we have two hammers. And let's take a quick look at what defines a hammer. So a hammer should have a small real body and a long lower shadow. And the real body is this wide part of the candle, and shadows are the longer part. And the lower shadow is the shadow that is below the real body. So in this case, you can see we have a small real body, green real body, and we have a long shadow. In general, in order for it to be a hammer candle, we want the lower shadow to be at least twice the length of the real body. And as you can see here, a hammer candle can be both green and red. One could argue that the green one is a bit better than the red one, but both are definitely counted as hammer candles and both are valid hammer candles. And the difference between the green one and the red one is basically that the green one closes up here and the red one closes down here. And what does the hammer candle actually tell us? Well, it is considered a reversal candle. It is a reversal pattern, so it indicates that the price might reverse. But one very important thing when it comes to the hammer candle is that in order for it to be a valid candle, it needs to come after a price decline. So we can say here, must come after a decline. So let's say we have a hammer right here. I hope you can see down here in the corner. In order for it to be a valid hammer, prior to the hammer, we must have had a price decline. And then hopefully the hammer will make the price reverse. If we have price action that goes, for example, sideways, and then we have a hammer, then it's not a good and it's not a valid hammer candle. Now, when we have a brief understanding of the hammer candlestick, now let's take a look at a quick example. So right now we're looking at the gold price, and on the chart, can you spot the hammer? Well, the clear hammer on this chart is right here. As you can see here, the shadow is more than twice the length of the real body. So that criteria is good. And we can also see here that the hammer appears after a price decline. And in this case, after the hammer, we actually saw a very nice bounce to the upside. So in this case, the hammer candle played out beautifully. And another thing I can just mention here is that when you actually trade, most of the times you don't want to use only candlestick patterns. Preferably, you always want to combine your candlestick patterns with other trading variables. For example, support resistance, you can use indicators, you can use divergences, and so on and so on. Right, so the inverted hammer pattern. What is it? Well, first of all, we can say that this is a bullish reversal pattern, indicating a potential reversal to the upside. So it's no certainties in trading, but the inverted hammer indicates that if we have a strong downtrend here and we see an inverted hammer appearing, then this is a possible sign that the trend might reverse either to the upside or that the trend reverse to a neutral trend. So a trend can go from down to up, but it can also go from down to sideways. But okay, so how do we actually identify the inverted hammer? So the inverted hammer should have a small real body and a long upper shadow. So the real body here is the sort of wide part of the candle. So this is the real body. This right here is also the real body. And the upper shadow is this part right here. And the reason we call it the upper shadow is because the sort of line is above the real body. And as you can see here in this illustrative example, we also have a small lower shadow, right? And that is another criteria for the inverted hammer, that the lower shadow should either be very small or not there. So we can say small or none. The lower shadow should be small or none, the real body should be small, and the upper body should be long. In general, we want the upper shadow to be at least 2 times as long as the real body. So in this case, you can see that the upper shadow is pretty much 4 or 5 times as long, but at least we want the upper shadow at least to be 2 times as long as the real body. And as you can see here, the inverted hammer can actually be both green and red. And one could say here that the green one is a bit more bullish. So if you're looking for a trend reversal, the green one is preferable, but the candle can actually be both green and red. And this might, feel a bit weird because the red one, the candle right here, doesn't look that bullish. But since the bulls are pushing the price very high during the day, it is still an indication that the downtrend might end and that we might be seeing a bullish reversal to the upside. Now let's take a look at a real-life example of the inverted hammer. So right now we're looking at 1-hour candles on the Dow Jones Industrial Index. And as you can see here, we had a pretty strong downtrend right here. And then a familiar candlestick appeared. You can see right here, we printed an inverted hammer. You can see the shadow here is more than twice as long as the real body of the candle. And since we're talking about a bullish reversal candle, the candle must appear after a downtrend. And prior to this candle, we actually had a strong downtrend. So that criteria is met. And we can see in this case, after we saw the inverted hammer, the trend sort of changed from down here to sideways, right? So it's not necessarily that we right away see a bounce after a inverted hammer. As a matter of fact, in the real markets, we very seldom see a super clear reversal right after a pattern. It's more often a bit more noisy, like here. But still, after this one, we saw a sort of reversal to a neutral trend, and then we started to trade up here. Right here, we have 2 examples of hanging man candlesticks. And if you have watched my video on the hammer candle, you may wonder here, isn't this the exact same thing as the hammer? Well, the actual look of the candle is the same, but we can actually say that the hanging man is the exact opposite of the hammer because it is the bearish counterpart of the hammer. But let's start here by taking a look at how does the actual candle look like. So first of all, the hanging man candlestick pattern has a small real body, and the real body is this part, the sort of wide part of the candle, and it also has a long lower shadow. And this right here is the shadow, and lower shadow basically means that the shadow is below the real body. In general, we usually want the lower shadow to be at least twice as large as the real body. So in this example, you can see that the sort of lower shadow is much longer than the real body. It looks like it's more than 3 times as long. So that criteria is good for this candle. And now to the difference between the hanging man and the hammer. The hanging man is a bearish reversal pattern. And by bearish, we basically mean that the hanging man pattern indicates a potential reversal to the downside and not the upside. So the hanging man can act as a warning sign that the uptrend might reverse. And this leads us to the next point here, and that is the hanging man candle must appear after an uptrend. So let's take a look at an example of a valid hanging man. If we have an uptrend right here and you have a hanging man appearing, then in this case, this is a valid hanging man pattern. And hopefully this will lead to a reversal here to the downside. But if we, for example, have a trend that looks like this, you know, just sideways, not really trending at all, and then we have a candle that looks like this, in this case, we wouldn't even call this a hanging man candlestick, because in order for it to be a hanging man, it needs to come after an uptrend. But all right, so now when we have a general sense of the hanging man candlestick, now let's take a look at a quick example. And can you spot the hanging man candle on this chart? Well, the hanging man candle is right here. And this is actually a valid hanging man. And the reason for this is that it comes after an uptrend, right? So it comes after an uptrend. The lower shadow of this candle is more than twice as large as the real body. So the criteria here is met. And after that, we saw an impulse here to the downside. Another thing I forgot to mention earlier is that the hanging man can be both red and green, but preferably we want to see a red hanging man. It is a bit more bearish to see a red one. But both are valid hanging man candles. And in this case, it actually played out. And after we saw the hanging man, we actually saw a nice, force to the downside. So what is the shooting star candlestick pattern? Well, it is a bearish reversal pattern. And by bearish, we means that it indicates a potential reversal to the downside. So this leads us to the next sort of criteria, and that is that the pattern has to come after an uptrend. So prior to the pattern, we need to have some sort of uptrend. So let's say this is the price action. We have a shooting star up here right here. Looks something like this. Sorry for the ugliness. Then the pattern suggests a potential reversal here to the downside. If we, for example, have sideways price action and then a shooting star up here, in this case, this would not be a valid shooting star because the shooting star has to come after a price increase or an uptrend. And preferably, we want to see a strong uptrend prior to the shooting star pattern. Right, so how about the appearance? Well, the upper shadow has to be at least twice as long as the real body. And the real body is the part right here and right here. And the upper shadow is here, and the same thing applies for the red candle. And as you can see below the real body, we have the lower shadow. So this part right here is the lower shadow, and the lower shadow of the red one is down here. And a perfect shooting star candle would have no lower shadow, but it is okay to have a small lower shadow, as you can see here on the picture. So we can say little/no lower shadow. I hope you can see, it's a bit messy now. So this is basically what the shooting star looks like. And as you can see on the screen here, we have two different separate shooting star candles. And the shooting star candle can be either green or red. And the red one is a bit more bearish than the green one. And the reason for this is that in the green one, we have during the day, we have a strong increase and the price reach a maximum all the way up here. But the bears during the day managed to push the price down and close down here. But in the red one, the same thing applies. During the day, the bulls push the price up here. But in this case, the bears managed to push the price all the way down here and managed to close right here, which is below the open price. The open is right here. If you want to learn more about, how to read candlesticks, I actually have a video about that, and I can link it up in the corner in the eye. But as I said, both green and red are fine, but the red one is a little bit better and a little bit more bearish. But all right, guys, so now I think we're ready to take a look at a real life example. So right now we are looking at gold, and we are looking at the 4-hour time frame. So every candlestick represents 4 hours. And can you spot the shooting star on this chart? Well, it is possible that we have more than one, but the most clear one is this one right here. As you can see, prior to the pattern, we had a strong increase, which is good. We saw a shooting star candle right here. We set the very high of the trend, and after this shooting star, we started to trade here downwards. And I can also just mention here that most of the times you want confirmation before you trade the shooting star pattern. So traders usually don't enter on the actual day of the shooting star. They usually wait for a new candle to close below the shooting star candle. And depending on your risk tolerance, some traders want a whole candle to close below. Some traders just want a candle close. It can basically depends on your personal risk profile. All right, so the piercing candlestick pattern. Well, first of all, we said that it is a bullish reversal candle. So that means that prior to the pattern that looks something like this, we need to have a downtrend. So the piercing pattern is only valid if we have a downtrend prior to the actual pattern. So if we, for example, have a sideways movement and then we see a piercing pattern appear, then it is not a valid piercing pattern. We need to have a downtrend, and preferably a strong downtrend, in order for it to be valid. But alright, so how does the pattern actually look like? Well, the pattern consists of two candles, and the first one is a strong red candle where the bears are in full control. So this is candle 1, a strong red one. And the important thing about the next green candle is basically two things. First of all, the open right here needs to be below the red one. So the green one actually needs to gap down, and this is only possible in some time frames. For example, daily candles when we look at stocks. But the green one needs to open below the real body of the red one. So it needs to open below the real body here. By the way, guys, if you're interested in learning more about how to read candlesticks, I have a video about that, and I can link it up in the corner in the eye. But the green candle needs to open at least below the real body of the red one, and preferably even below the lowest point of the red one. So preferably the green one opens below the wick. The second criteria here is that the candle close of the green one should be above the 50% mark. You can see this line right here. That is the 50% mark of the red candle's real body. So the green one needs to close above this line in order for it to be a piercing pattern. And one cool thing you can do here is that if we actually add these candles together, what would we get then? Well, then we would get a structure, right, that looks something like this, right? So if we put both of these candles together, we would actually have a candle that looks something like this. And this is actually pretty much a hammer candlestick pattern, which is also a bullish reversal candle. So that can maybe help to understand why this is a bullish candle, because if we add them together, we pretty much get a hammer. But alright guys, so now let's jump into the chart here and take a look at a real life example of the piercing pattern. Alright, so right now we are on the Apple stock and we're looking at daily candles. So every candlestick represents one day. And can you spot the piercing pattern on this chart? Well, as you can see right here, we have a piercing pattern. And the reason this is a piercing pattern is because all the criteria is met. First of all, it comes after a downtrend, a strong force here to the downside. And here, the green candle closes above the 50% mark of the red one. And it also opens below here. So that criteria is met. So right here we have a piercing pattern. And after this one, we actually saw a nice continuation to the upside here. One thing I can also mention is that, you know, as with all candlestick patterns, it is recommended and preferable to use them together with other technical variables. For example, support resistance. So the dark cloud cover, what is it? Well, the first thing I want to say here is that this is actually a bearish reversal pattern. And what does a bearish reversal pattern mean? So what this means is basically that the pattern indicates a potential reversal to the downside. So the dark cloud cover must come after an uptrend. So, so prior to the actual pattern, if this is the price action right here, we must have had an uptrend. So it might look something like this, perhaps looking something like this. If we, prior to the pattern, instead would have had, you know, for example, sideways price action, so we had something that looks more like this, then this would not be a valid dark cloud cover. The dark cloud cover, one criteria is that it has to come after an uptrend and preferably a strong uptrend. So it is not a valid pattern either if it comes after a downtrend, of course. But okay, so what defines the pattern? Well, the pattern consists of two candlesticks. First, we have a green, pretty strong candle, as you can see on the picture right here. The important thing about this pattern is that the second candle is red. And the open of the second candle, you can see it opens right here. It has to open above the real body of the prior green candle. And the distance here between the close of the green and the open of the red is what we call a gap up. But in this pattern, during the day, the bears managed to push the price down all the way below this black line right here. And this black line is basically 50% of the real body of the green candle. So the red candle has to close below the 50% mark of the previous green candle. So this is basically the two criteria for the dark cloud cover. And one interesting thing here that we can do is that if we combine both of these candles, then we would have a candle that looks something like this, right? It opens down here, and after both of the patterns are done, we have a close down here. And as you can see, this pattern is actually very similar to the shooting star pattern. Remember, if we had no lower wick here, this would be a perfect shooting star pattern. So for some people, it is helpful to combine the patterns and see that this is actually a bearish pattern. Some people call this, candlestick math, when you add the candlesticks together or split them up. But yeah, guys, that's about it for the theory. Now I think we're ready to take a look at a real life example. All right, so right now we are looking at the Apple stock, and we are on a daily time frame. So every candlestick on this chart represents 1 day. And can you spot the dark cloud cover on this chart? Well, right here, you can actually see a dark cloud. Why is this a dark cloud cover? Well, prior to the pattern, we need to have an uptrend. And that we do have right here. You can see we have an uptrend prior to the pattern. Then we have one green candle and we have a red candle that opens above and closes lower than the 50% mark of the previous green candle. So all the criteria is met here, and after this candle we actually saw a pretty strong reversal to the downside. Let's take a look at the Doji candle right here, and on the screen you actually see 4 different types of Doji candles. But what defines a Doji candle is that the candle opens at the exact same level as where the candle close. So before watching this video, it's actually important to understand, how to read candlesticks. And I actually have a video about that, and I can link it up in the corner. But a candlestick basically looks like this, something like this. This is an example of a bullish candlestick where the candle starts and opens here, and it closes at the top of this part right here, which we call the real body. And what a Doji candle is basically that if we make this real body smaller, so we can make it a bit smaller like this, then we have an open here and close here. But if we make the opening price and the closing price very, very close to each other, then the candle will basically just look like a cross. And this, cross-looking structure is basically the Doji candle. It is, however, okay to have a, small real body. So if we have a candle that looks maybe something like this, we can still call it a Doji candle. But when the body gets a bit larger, we're talking about a spinning top candle. And I'm planning on making a video about that in the future as well. But alright guys, so what does the Doji candles actually represent? In general, we can say that they represent market indecision. And by indecision, we mean that neither the bulls or the bears are in full control. You can see if we look at this perfect Doji example right here, you can see that during this candle we have a push up, but we also have a push all the way down, and at the end of the candle we close at the exact same level as we started. So we neither have a clear direction to the upside nor a clear direction to the downside. So the candles by themselves represent pure indecision. But then we have some different types of doji candles. First of all, we have the doji star candle, which is sort of a doji here where the upper shadow and the lower shadow are about the same length or a bit longer than the horizontal lines right here. And you know, this is of course a perfect example. So most dojis will look more something like this, perhaps something like this, or something like this. It's very, very seldom you will get a perfect doji star. But yeah, this is what we call a doji star. And if we have very large upper and lower shadows, then we call it a long-legged doji. And this is an even more extreme example of the indecision. We have, you know, strong impulses to the upside during the candle. We also have strong pushes to the downside during the candle. But at the end of the session, we still, you know, end up where we started. So this is a, you know, massive indecision candle. And we will take a look at an example of the long-legged doji later in this video. The next candlestick is what we call a dragonfly doji. And this one is actually an extreme example. And this one is actually a little bit more bullish than bearish. Because in this case, you can see we open all the way up here. During the candle, the bears managed to push the price down. But at the end of the candle, we see the bulls taking control once again. And we close here where we started. So this is a candle where sort of the bulls are showing more control. And you can compare this one with the hammer candle that looks something like this. And as you can see, this dragonfly doji is pretty similar to the hammer. The hammer is a bit more bullish or indicates a stronger momentum to the upside, but the dragonfly doji is almost like a hammer. And then we have the gravestone doji here. It kind of looks as a gravestone, and the same thing applies here. This one is a bit more bearish, so the downside momentum is a bit more in control for the gravestone doji. Here we open here. The bulls managed to push the price up, but before the close, the bears managed to once again take the price all the way down to where it started. And you can actually compare this one to the bearish shooting star candle that looks something like this. They are pretty similar, but the shooting star is a bit more bearish than the gravestone doji. Alright, okay, so now when you have a clue about what a doji represents and some different types of dojis, now I think we're ready to take a look at some examples and where a doji makes sense and where it doesn't provide as much value. Alright, so here we are looking at the gold daily time frame. And one concept that is important here when it comes to dojis is that if you found a doji on its own, it usually doesn't provide a lot of value. A doji provides more value if it comes after either a strong decline, so we have a strong decline and then a doji, or if it comes after a strong increase and then we have a doji. The doji candle is also found in many candlestick patterns, and if you have a doji in a candlestick pattern, it provides more information than if you just find a doji. If you have, for example, sideways action and then a doji, then it doesn't provide much value at all, because the doji by itself represents market indecision, as we talked about. And if you have a candle that represents market indecision after a long period of just indecision, it doesn't provide, you know, any additional value. But let's take a look here. So right here we actually have a doji. This one has, you can see, a little real body, so a little green part of the candle, but I would still consider this a doji. And this is actually a doji that provides, you know, a lot of value. And why is this doji important? Well, it is because it comes after a very strong decline. So during this decline, you can see that the bears or the downside momentum here is in full control. So this means that the control switches from the bears having full control to market indecision. So here we have a clear switch in the market. And you can also see that this is pretty much a long leg doji. And the following candle, we actually had a strong bullish candle. So this can pretty much act as a confirmation here that we are seeing a switch of momentum, and that at least the strong force here to the downside seems to be cooling off. If you instead look I hope you can see we have a doji right here. This doji doesn't really provide much information at all. Why is this doji less important than this one? Well, it is because it comes after, you know, sideways movement. When we see a doji candle after sideways movement, it doesn't provide, you know, as much information than if it comes after a strong move. All right, so first of all, let's take a look at how the spinning top candles actually look. So let's try to draw a spinning top candlestick right here. And what is special for these candlesticks is that we have a pretty short real body, but we have long shadows. So a spinning top looks something like this. So as you remember from a previous video, which I will link up in the corner in the eye if you want to learn more about the names I'm going to use in this video. But this large rectangle in the middle is what we call the real body. So this is the real body. And here we have the upper shadow, and here we have the lower shadow. All right, and how do we know that we are talking about a spinning top candlestick? Well, spinning tops, first of all, they have a short real body. So let's write that down. So this part right here has to be short. And the second thing about spinning tops is that the real body is centered between long upper and lower shadows. So as you can see here, the real body here is pretty much in the center of the upper and the lower shadow. And the real body doesn't have to be exactly in the center, but it has to be pretty close to the center in order to count as a spinning top. So this is basically how they look like. All right, so now let's take a look at what spinning top candlesticks actually mean or might indicate. And to do that, we are going to look at a chart here, an example. So let's take a look at the chart. This is an example. This is the gold chart in US dollars. But what we're going to look at, we are going to take a look at the spinning top we have here, where we actually pretty much have two spinning tops, right there and right there. And what can we see here? Well, before these two spinning tops occurred, we had a small rally here. We had long and strong green candles, which indicates a pretty one-sided price action. When we have price action to the upside, we usually call it bullish. So here we can say that we had a bullish price action. So we had a bullish price movement here, and then the spinning tops occurred. And what does it mean that after a rally you see some spinning tops? Well, a spinning top indicates that the bulls or bears, in this case we are talking about the bulls, are losing momentum. So they are losing control over the price action to the upside. And in this case, this was actually confirmed two times here. We had two spinning tops, and then after that we actually saw a huge drop here. And it's actually true that spinning tops might be a first clue that the price action will reverse. So we can write, it might be a first clue of a reversal, but you should never trade for a reversal only by seeing a spinning top. You always want confirmation that we are seeing a reversal before you take action. In this case, we actually got some form of confirmation on this day. We had two spinning tops, and then we had a strong red candle here. And that indicates that the bears is back in control, and that a price drop might be on the horizon. One important thing to learn here is that, let me write it down here, we need more data to confirm a reversal. We can't just look at a spinning top and think the price will reverse. Oftentimes the price might go sideways, or it might go sideways for a while and then continue to the upside. So you always want to look for a confirmation that the price is changing direction if you want to trade for a reversal. First of all, let's zoom in a bit and take a look at the pattern. So the Harami pattern, what is it? Well, It is a 2 candlestick pattern, so a pattern that consists of 2 candlesticks. And the pattern can be either bullish or bearish depending on where on the chart it appears and how it looks like. And the Harami pattern might indicate a possible trend reversal. And this can mean a reversal from a bullish or upwards trend to a downwards trend, or from a bearish downwards trend to a bullish upwards trend. But important here is that it can also mean that it goes from up to neutral or from down to neutral. So it doesn't have to go from up to down. Now let's take a look at how the candle actually looks like. So as I mentioned, we can have either a bullish Harami or a bearish Harami. So let's start off by taking a look at the bullish Harami. So the first thing about the bullish Harami is that it appears during a downtrend. So prior to the actual pattern, we might have had some red candles like this. And the first candle is a large red real body. And by the way, if you are unfamiliar with any terms I'm using in this video, I have a video about some basic candlestick terminology, and I will link it up in the eye in the corner. But the first candle is a large red real body. So the real body is basically the part that looks like a rectangle. So this is the real body, and it can have some shadows. Maybe look something like this. And the second candle here is a green real body that is contained within the red real body. So it might look something like this. By being contained, we mean that the open and close price of the prior candle kind of engulfs the green one. We see that the red real body is both above and below the green real body. And one important thing to notice here is that if, for example, the shadow of the green candlestick here is above the red one, that doesn't really matter. The important thing is that the green real body is contained within the red one. And this candle you see right here might look familiar. This is actually a spinning top. And if you want to learn more about it, I have a video and we'll link it up in the corner in the eye as well. And so this is the bullish Harami. The bearish Harami is the exact opposite. So I can just show it real quick here. So the bearish Harami. For this one, I'm not gonna write anything. I'm just gonna show how it looks like. So prior to the pattern, we need some kind of uptrend. So it might look something like this. The first candle is this green one, might have some shadows here. And the second candle has to have a real body, a red real body that is contained within the green one. So it might look something like this. So as you can see, it is the exact opposite of the bullish Harami. This one might indicate that the trend will change from up to down or from up to sideways. Now let's take a look at some interesting things about the Harami pattern. One thing to notice here is that the Harami pattern is the reverse of the engulfing pattern. And if you want to learn more about the engulfing pattern, I have some videos about that. Another thing that I think is worth to note here is that the pattern requires confirmation. So after we have seen a Harami pattern, that doesn't tell us enough to say if the trend is about to change from up to down, from up to sideways, or whatnot. So what we usually need is that we need a confirmation candle that confirms the validity of the Harami and also gives us a clue if the to what direction the trend is changing. But all right, guys, I think we're now ready to look at some charts. But before doing that, I just want to give a quick disclaimer that everything in this video is for educational purposes only, and nothing should be considered financial advice. Now let's take a look at some charts here. The first chart we're going to take a look at is the one we had a glimpse of in the intro, and that is the S&P 500 index. As we can see here, we had a strong bullish trend or upwards movement, But then a Harami appeared right here, a bearish Harami. And why is this a bearish Harami? Well, the first candle was a strong green real body, and the second candle was a real body that is contained in the green one. And after this pattern occurred, we saw a third candlestick that closed below both of the prior candles and confirmed that the upwards movement is coming to an end. And after that, we actually saw a pretty steep price drop, and the trend changed to a more of a sideways movement here for a while. So the Harami can give an early clue that the trend is about to change. In this example, I'm actually going to take a look at two Harami patterns. The first one appeared after a strong rally. This is Apple right here. And here we had a very strong upwards movement, but this bullish momentum ended with a bearish Harami pattern right here. And this one is barely a bearish Harami pattern, but as you can see, the first candle is a strong green one, and the red candle, even though the red candle is large, it was contained within the green one, and therefore it is a Harami pattern. After this, we had a change of the trend, and the trend was neutral. And then actually here we can see that another Harami pattern appeared. And the Harami patterns doesn't say too much when we are in a neutral trend as we were here, but in this case the Harami pattern actually marked the start of a steep decline here. But the most significant Harami pattern in this example, I would say, was this one right here that changed the trend from a upwards movement to a sideways movement. Let's zoom in a bit and take a look at what the pattern actually is. So let me pop up paint here. All right, so the morning star pattern. What is it? Well, first of all, it is a pattern of 3 candlesticks, and the pattern is considered a bottom reversal pattern. So it is a bullish reversal. And now let's take a look at the 3 candles that makes up the pattern. So candle 1 is a long red candle, or to be more precise, it is a long red real body. And by the way, if you are unfamiliar with any terms I'm using here, I actually have a video about the basic candlestick pattern terminology, and I can link it up in the corner in the eye. So if you're unfamiliar with any terms, I recommend watching that video before continuing with this one. But yeah, the first candle is a long red real body. So if you know the terms, you know that the real body is the body that looks like a rectangle here. So it would look something like this, maybe has some shadows like this. And then candle 2. So candle 2 is a small real body that doesn't touch the red real body. So it will look, for example, something like this. It's important that the real body here is small, but it doesn't matter if the shadows, for example, looks like this. If the shadows cross over to the red candle's real body, doesn't really matter. And it also is okay if this candle right here is either red or green. If you're looking for a bullish reversal, green might be a tiny bit better, but it doesn't really matter here. When this candle appears after a strong negative momentum, that means that the bears are losing control and losing momentum. The third candle here. The third candle is a green real body that goes deep into the red one. So it will look, for example, something like this. You can see that the green real body here, what I mean by going deep here is that the green real body goes all the way up here. So it goes up deep within the red candle like this. And in order for it to be a real Morningstar pattern, we need the green candle to go deep within the red one. And preferably, we want to see the green candle gap up here. So if we delete this part, it would be even better if we have some space between the small green real body and the next candle, candle 2 and candle 3. This is not a must, but in a perfect case, we want a gap up here. But as I said, it's okay if the green one looks more like this. All right, and another thing here is a good thing to know about this pattern is that the lowest low of the pattern should act as support. So in this case, the lowest low of the pattern is this blue point right here. So in this case, we should have some kind of support line here. And one thing that is always true with supports is that if we have been seeing reactions at this price level before and this Morningstar pattern reinforces the support, that is better. So the more touches on the support line, the stronger. But let's say, for example, that the lower shadow of the red one was all the way down here, then this support would more accurately be all the way down here. But again, support lines aren't really lines, they are more like zones. So you should never look at support lines as exact lines. But alright guys, I think we're now ready to look at some charts. But before doing that, I just want to give a quick disclaimer here that everything in this video is for educational purposes only, and nothing in this video should be considered as any type of financial advice. But yeah guys, now take a look at some charts here. Alright guys, so here we have Nvidia, a US tech stock that has been performing very well recently. And this one we showed in the beginning that we have a Morningstar pattern right here. And let's take a look at this one and see, okay, so why is this one a Morningstar? Well, first of all, the first candle, candle 1, is a red large real body. And that was our criteria for the first candle. Another criteria, as we said in the beginning, is that this is a reversal pattern. In order for it to be a reversal pattern, we need a downtrend prior to the pattern. And here we can see that we have a clear downtrend. The second candle here has a small real body and it doesn't touch the red one. So that is true. And the third candle here, we can see that it goes pretty deep into the red one. And our criteria for the second candle is basically that the real body of the green one goes deep into the red one, and that it does. And also, according to what we said, we should get support around this blue line right here. And as we can see here, the price action reversed after this Morningstar and a price increase started to happen. Let's take a look at one more example. All right, so now we're taking a look at the NASDAQ index right here. And can you see the Morningstar I'm trying to identify here? Well, the pattern I'm thinking of is actually, it's not easy to see, but I'm thinking of this one right here. Because here we had a downwards movement here, clear downwards movement. We had a large red candle right here. Then the second candle, the candle right there, is a small real body. And when we zoom in, we can actually see that it doesn't touch the red one. So technically, this one meets the criteria for a Morningstar pattern. We can also see that the third candle, the green one here, goes all the way up here. So it goes deep into the red one. And after this pattern, we had some sideways movement here before the price continued to the upside. So let's zoom in a bit here and take a look at the pattern. So the evening star pattern, what is it? Well, it is a 3 candlestick pattern, a pattern that consists of 3 candles. And the pattern is a top reversal pattern, so it appears after a rally. And we can also mention that the evening star pattern is the bearish counterpart of the Morningstar pattern. And if you want to learn about the Morningstar, I already have a video about that and we'll link it up in the corner in the eye. So the Morningstar is the bullish reversal pattern, but the evening star is a bearish reversal pattern. And that is what we're going to look at in this video. So I think now we're ready to zoom in and take a look at, okay, so how does the pattern actually looks like? So let's have a look at each candle of the pattern. The first candle, candle 1, The first candle, candle 1, is a long green candle. And the important part here is that the real body is long. And if you are unfamiliar with any terms in this video, I made a video about that where I explained the basic Japanese candlestick terminology and the basics of candlesticks. So if you feel like you don't understand any terminology, I recommend watching that video before continuing with this one. But the first candle, candle 1, has a long green candle. Maybe look something like this and have some shadows right here. And also the important thing here is that this green candle appears after a rally, after a upwards momentum. So prior to this one, we might have had some more candles that led up to this one. But the first one is a long green candle. That's the main thing. Candle 2 here. Candle 2 has a small real body. So this big part of the candle has to be small, maybe look something like this. And the small real body doesn't touch the green one's real body. So we need some space in between the green and red candle here. So it might look, let me delete that, it might look something like this. So as you can see, we have some space here in between. And that is important. The final candle, candle 3. Candle 3 is a long red real body that penetrates deeply into the green one. So it might look something like this. We have a long red real body. And what do I mean by penetrates deeply? Well, we want it to go deep down within the green one. So in this case, the end of the red one's real body stops here. So we say that the penetration is this yellow area right here. So it's important that the candle 3 penetrates deeply into the green one. Also, preferably we want a gap between this candle 2 and candle 3, but that isn't a requirement, but it usually makes the pattern stronger if we actually have a gap in between candle 2 and candle 3. This is candle 2, this is candle 3. Another thing here, now I'm gonna delete the candles here. Another thing that is good to understand about the evening star is that the highest point, which in this case is this point right here, should act as resistance in the future. So right here, we are forming a resistance. So we can write here. So the highest of the evening star should act as resistance. And as always, when it comes to resistances, the more touches we have on it, the stronger it becomes. And other factors that makes a resistance stronger or weaker is, for example, volume, and perhaps the resistance have acted as support earlier and similar things like that. But I think this is pretty much the basics of the evening star. Now I think we're ready to look at some real life charts. But before doing this, I'm just going to give a quick disclaimer that everything in this video is just for educational purposes only, and nothing in this video should be considered financial advice. So now I think we're ready to take a quick look at some charts here. So the first chart, the chart we looked at in the beginning, is a chart of Nvidia right here, a US tech stock, very big US tech stock. And the pattern we have circled in here is a evening star pattern. In this example, I just want to go through why this is a evening star pattern. All right, so I kind of had some technical problems, but now we are back. So we're looking at the reasons why this pattern right here is a evening star. And the first reason is that it is a top reversal, and in order for us to have a top reversal, we need a rally that leads up to the pattern. And in this case, we had a clear rally here before the pattern, so that is true. And also, let's take a look at the criteria that makes it a evening star pattern. First of all, we need a strong green candle, and that we have. The second candle should have a gap up between the first and second one, and that we have. And it should also have a small real body, and that is also true. The red one should penetrate deep into the green one, and we can see that the penetration of the red one is indeed deep. So this pattern right here meets the criteria for a evening star pattern. And we can actually see here that after this pattern, the price of Nvidia stock actually fall. This pattern worked out well. Now let's take a look at one more example here. All right, so now we're taking a look at Goldman Sachs, a US bank. And can you find the pattern? I'm trying to get that here. Well, the pattern is this one, a beautiful evening star pattern. Why is it an evening star? Well, the pattern appeared after a rally, right? The first candle is a strong green one, so that is true. The second candle is a small real body that opens above the green one. And in this case, it maybe just barely touches the green one here, but evening stars are very hard to find. So, so for the sake of this video, let's say that it doesn't touch the green one. So that is also true. And a general thing about patterns is that it's never black and white. It doesn't make a huge change if it barely touches or if it is just above. The psychology behind the pattern is still the same thing. So you don't have to be very, very strict here. So we can say that the second candle is in check. The third candle goes deep within the green one. It goes down all the way here. So the criteria for the third candle is also true. We can see that after this pattern, we actually saw a short correction here. But after that, the price continued up. First of all, let's zoom in on the pattern and take a closer look. So the Tweezer Top Pattern, what does it mean? Well, it is a candlestick pattern that consists of 2 or more candles. Many times we are talking about 2 candles, but sometimes we can even include more candlesticks in the pattern. And this pattern can act as a reversal signal. And since it is a top pattern, it might indicate that the trend is about to change from a bullish or upwards trend to a bearish or downwards trend. Or it can also mean that the trend is changing to neutral. And we can also right away mention here that it can be combined with patterns. And this might feel a little bit unclear, but later in this video, this concept will be more clear. So now let's take a look at some examples of how a tweezer top could look like. So the first thing that is true for every tweezer top is that the candlesticks have matching highs. So the candlesticks in the tweezer top pattern touches the same level, the same top. And ideally we want a long real body as the first candle and a small real body as the second candle. First of all, the long real body makes the prior or bullish trend more significant, while the small real body shows that the positive momentum is changing and that the bulls might be losing control. So one example of a tweezer top pattern could look like this. So prior to the pattern, we have a upwards trend. The first candle is a strong green one, might look something like this. And by the way, if you are unfamiliar with any terms I'm using in this video, I have a video about some basic candlestick terminology, and it will be linked up in the corner in the eye. But the first candle looks like this. The second candle could look, for example, something like this. This right here is a doji. But the important thing here that makes this a tweezer top is that the candlesticks have matching highs. So what we mean by matching highs is that we have the same level here and the same level here. So when we are talking about matching highs, it can either be shadows, but it can also be that the real body is touching the same level. So it doesn't matter if it is shadows or the real body that makes the high, every high counts. So here we have that the candlesticks have matching highs. And we also have a long real body as the first candle. So this is a good example of a tweezer top. And this one actually has a special name, because if you remembered from our previous video, we talked about the Harami cross pattern. And this is actually a Harami cross pattern. but it's also a tweezer top. So we call it a tweezer top Harami cross. And we can take a look at one more example of a tweezer top. We could have a strong first candle here, a strong green candle, followed by a candle that looks like this. You might be familiar with this candle. This one is actually a hanging man pattern. And the important thing here is that, well, they have the same highs here, or at least my ambition was to draw them with the same highs. So they have matching highs, which makes this a tweezer top. It also have a long real body as the first candle, which is ideally for the tweezer top, so that's good. But the name for this pattern is basically the tweezer top hanging man. And the cool thing about tweezer tops is that since they are touching the same highs, they make the support level more significant and also makes the possible reversal more likely and more significant. We can also just real fast here take a look at one more. We can take a look at the tweezer top shooting star. So that one is very familiar. We have a strong green candle, but instead of a hammer, we have a shooting star. Still, they touch the same high here and here. The first candle is green and strong, and that is good. And this pattern is called the tweezer top shooting star. And as I said before, the tweezer tops we can say that they add more bearish impact to the patterns. And that's why tweezer tops are a very useful tool. Alright, so now I think we're ready to look at some charts, but before doing that, I just want to give a quick disclaimer that everything in this video is for educational purposes only, and nothing should be considered financial advice. So yeah, now let's take a short look at some charts here. The first chart we're going to take a look at here is the S&P 500 chart, and it was the one I used in the intro. And right here, we can actually see that we have a tweezer top. Why is this a tweezer top? Well, first of all, it appeared after a upwards movement, a bullish trend. And we can see here that the candlesticks touches the exact same level there and there. And the first candle is a strong green one, so that's good. The second candle, we kind of preferably want it to be small, but in this case, it's actually pretty large. But one cool thing about this one is that you might recall it from a previous video, but this right here is actually technically a dark cloud cover, which is a bearish pattern. So we could say that this is a tweezer top dark cloud cover. And this one actually played out very well. After this pattern, we saw a start of a bearish downwards trend. Let's take a short look at one more example. Can you try to spot the tweezer top here? Well, I might have been a bit harsh on this one because the pattern I'm thinking about is actually this one right here. And in this case, we can see that they are actually supposed to touch the same level. In this case, the levels are a bit different. But as for all candlestick patterns, we need to not think in very, very strict terms. They can still be patterns, but not as significant if they aren't touching the same level. But this one right here is kind of a tweezer top shooting star, right? Because since the second candle, the red candle, has such a small lower shadow, we can kind of think of it as a shooting star. So this is a tweezer top right here, and we can see that the tweezer top actually marked a reversal from an upwards movement to a downwards movement. Right, so first of all, let's zoom in a bit and take a look at what the tweezer's bottom pattern actually is. So the tweezer bottom pattern, what is it? Well, it is a pattern of candlesticks that consist of two or more candles. The most common tweezer bottom consists of two candles, but it can also consist of more. And the tweezer bottom can signal a potential reversal. It can signal that a bearish trend or downwards trend is changing to a bullish one, or that it might change to a neutral trend. But we can hear here on the name bottom that we are talking about a bottom reversal here. And one more thing here is that it can be combined with other patterns. And what I mean by this will be more clear later in the video. But now let's take a look at how the tweezer bottom actually looks like. The first most important thing that is common for every tweezer bottom is that the candlesticks have matching lows. So the lows of the candles in the pattern, it doesn't matter if we're talking about shadows or if we are talking about the real body, the lows of the candles should be at the same level or at least around the same level. And by the way, if you feel like you are unfamiliar with any terms I'm using in this video, I have a video where I go through the basic candlestick terminology, and I will link it up in the corner in the eye. But the first thing here, the candlesticks have matching lows. Another thing, the first candle should preferably have a large real body. Why is this preferred? Well, because that candle reinforces the prior trend. So we can take a look at some examples of tweezer bottoms. The first one we're going to take a look at is the tweezer bottom hammer. And the hammer candlestick pattern is a very useful reversal pattern on its own. And if you want to learn more about the hammer, I have a video about that, and it will be linked up in the corner in the eye. But the tweezer bottom hammer, and here you will see why I in the beginning of the video said that we can combine it with other patterns. The tweezer bottom pattern consists of preferably, so prior to the trend, we have a bearish trend. The first candle should preferably be a red one with a large real body. It might look something like this. And then a hammer appears right here. The important thing that makes this a tweezer bottom is that the lows of the candles here and here are at the same level. And we said that we preferably want a strong large real body on candle 1, and in this case we have that. We can see that the red real body is much larger than the green real body. So this is an example of a tweezer bottom. Another one is the tweezer bottom piercing pattern. And if you want to learn more about the regular piercing pattern, I have a video about that, and it will be linked as the others in the corner in the eye. But the tweezer bottom piercing pattern, it's the same concept as the hammer. We have a downwards trend, and we have preferably a large red body here as the first candle. The piercing pattern is a pattern that goes deep within the red candle. It might look something like, maybe have some shadows here as well. The important thing about the piercing pattern is that we want the real body of the green candle here to pass this level right here, the 50% mark of the red candle's real body. And the thing that makes this one a tweezer bottom is that the lows here are at around the same level, almost the exact same level. Now I think we're ready to look at some real-life charts, but before doing that, I just want to give a quick disclaimer that everything in this video is for educational purposes only, and nothing should be considered financial advice. But yeah guys, now let's jump into the charts here. Alright, so first of all, we're gonna look at Goldman Sachs, and this is the pattern we saw in the beginning of the video, this one right here. Let's take a look at why is this a tweezer bottom pattern. Well, the first criteria, we should have a downtrend prior to the pattern, and that we have. The first candle, the red one here, is a strong red real body, so that's good. And we can see that what makes this a tweezer bottom is that the bottom of the candles appear at the almost exact same level, so there and there. We can also notice here that this is actually a Harami pattern, a bullish Harami pattern. And of course, I have a video about that, and it will be linked up in the eye in the corner. But this this tweezer bottom actually played out pretty well. This level right here marked the bottom of the short-term decline here, and we actually saw a upwards ascending trend. Let's take a look at one more example here. In this one, we're taking a look at Google, a company I think you're all familiar with. And can you spot the tweezer bottom I'm trying to get at here? Well, the pattern I'm thinking of is actually this one right here. And this one wasn't as clear, but we had a bearish momentum to the downside, and then a pattern of 2 or almost 3 candles appeared. The first candle was this red real body here, and the real body of the red one, this one, was big compared to the next candle, the green one's real body, this one, and that is good. We also see that the bottoms of these 2 candles appeared around same level. And after this pattern, we actually marked the bottom of this short-term decline, and a pretty long and stable uptrend started to appear. Alright guys, so that's pretty much it for this long video on candlestick patterns. If you guys found any value during the video, it would be super awesome if you can show that by dropping a like. And if you guys are interested in similar type of content in the future, please don't hesitate to subscribe and hit that notification bell. I hope you guys have an awesome day, and I hope I will catch you guys in the next video. But for now guys, take care. Ciao ciao.